Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day everyone. Welcome to the Bert Salazar Show. I'm excited to be here with each and every one of you today. And today's a special day because it is Tuesday, November 3rd, 2020. And it's actually election day. So hopefully sometime tonight, if not tomorrow, we'll figure out or we'll find out. Obviously, there may be some litigation along the way, but we may find out who's going to be the next president of the United States over the next 4 years and so forth. So today's episode, actually, the episode is 134. So we've done 134 episodes of the Bert Salazar Show. And the name of this episode is Money Never Sleeps, Pal. You know, if you recall the movie Wall Street and then the sequel to that, Wall Street 2, I'm going to be talking to you about some things that are critically important because at the end of the day, we're in the middle of an election. We have no idea who's going to win. We have no idea when we're going to find out who's going to win or who has won. And most important, no one knows what's going to happen to the economy in the next 6 months or 12 months or the next 5 years because there are so many moving parts, and now that we're dealing with the coronavirus and the pandemic, this is actually working against us in many different ways. So I want to kind of talk a little bit about the Gordon Gekko character story. You know, if you recall, Gordon Gekko was the main character in the movie Wall Street and then Wall Street 2. And actually, you know, if you remember the movie, you know that at the end of the first movie, he went to prison for insider trading and so forth, and I think he spent like 8 years in prison. But although Gordon Gekko is a fictional person, he is by no means fictional at all. And the reason for that is that there are several Gordon Gekkos in the financial world today. Not only in the United States, but all throughout the world. And these are very, very powerful individuals that have the contacts and money and the ability to make decisions on behalf of the entire world. And that's something that we need to keep an eye on, especially during an election cycle. Now, the challenge with the Gordon Gekkos in this world is that, and the opportunities for them is that, interesting enough, most of them are going to jump out of the airplane prior to crashing. So, you know, most of these people that were involved in the crash of 2008 and other crashes that we have had in the past were actually able to bail out prior to the crash because of the fact that they had insider information that most of us did not have. So, like I said, most of them are going to jump out of the airplane prior to the crashing. Now, when we start thinking, and I've been doing this now for 32 years as a retirement strategist and a tax planner, you know, I spend a lot of time dealing with my clients, educating my clients, providing information to my clients, and most important, saving my clients from themselves. And I also obviously spend time doing this podcast, which I do once a week, every single week, no matter what. And also the webinars and the videos, the educational videos that I put out, and then the seminars that I do at colleges and universities. I spend a tremendous amount of time educating my online community and Americans all throughout the United States. And I can tell you that there are three critical assets that are very, very important to each and every one of us. Now, the most important asset in the world is time. If you don't have enough time, chances are you're not going to be very successful. If you have plenty of time, then the opportunities of success are going to increase dramatically for you and your family. And you can apply time to anything. But remember that time is very finite. So that means that you don't have an overabundance of it. because most of us have a tendency to waste time every single day of our lives. So the most important asset for me in the world is time. The second most important asset in the world for me is information. So information, although there's more information in the marketplace than ever before, in many ways Americans are worse off than they've ever been. And the reason for that is that information without education always leads to failure. But having access to information and having the proper time is critical if you want to succeed, not only for yourself, for your family, for your business, but if you want to be an overall success in your financial, in your personal life. And then the third most important asset in the world is knowledge. So if you really think about this, if you have time, information, and knowledge, then you own the world. And this is the Gordon Gekko story, because there are a number of Gordon Gekkos all throughout the financial world, and they get to dictate how the world moves and where does it go to. So once again, if you have time, information, and knowledge, then you own the world. The challenge for most of us, and most of you, is that we don't spend enough time trying to figure out these things, and we're just marking time and hoping for the next day and the day after that and so forth. Now, in the movie Wall Street, one of the famous quotes from Gordon Gekko was, "Money never sleeps, pal." And he's very, very right about that, because money is a continuity. Money never, ever sleeps. You know, for those of you that have ever been involved, or you have dealt with someone that has been involved in institutional banking or world banking, money never, ever sleeps. It's always moving. Money is not lost. Money is primarily transferred from one group or one person or one institution to another, and there are values that go along with it. But at the end of the day, money never sleeps, and therefore, neither should you. You should not be sleeping with your money. You should be understanding your money. You should be looking at the efficiency and the effectiveness of your money when it comes to your financial decisions, and the only way you're going to be able to do that is if you look at your financial life through a telescope as opposed to a microscope. The Gordon Gekkos of the world do not look at their financial world or the financial world through a microscope. They look at it through a telescope. Now, the other statement that was very critical in this movie was that, you know, bulls make money, bears make money, and sheep, they get slaughtered. And by the way, I have heard that saying over the past 30 years, because at the end of the day, if you don't have the time, the information, and the knowledge, then you're pretty much sheep and you're going to get slaughtered. So what does that mean to each and every one of you? Well, what it means is that the average investor is the sheep in the slaughterhouse. And that's one of the challenges that I see when it comes to, you know, managing retirement assets on behalf of my clients, giving them recommendations, doing the videos that I do, and providing you with education along with information, because most of you are actually sheep and you're not doing your due diligence with your retirement assets that are so hard to come by and that you have worked so long to be able to put away and save for retirement. So let me go ahead and take you down memory lane a little bit, and I want to give you a little history lesson on the 2008 global economic crash. And you know what I always say to my clients is, be careful what you wish for, because you might just get it. So it all started pretty much in 1999, and that's when the Glass-Steagall Act of 1933 was repealed by Congress. President Clinton was in power at that point in time. So the Glass-Steagall Act of 1933 was finally repealed. It had been tried before, but finally in 1999 was repealed. And what the Glass-Steagall Act did in 1993, it created boundaries, it created barriers between banking, institutional banking, insurance companies, and banks. So they could not get into each other's business with the idea that each one of these groups would specialize in whatever it was that they did, and they did it to the very, very best of their opportunity along those lines. But after 1999, everything went away. All of a sudden, banks could get into the insurance industry. Insurance industries could get into the banking industry. Banks could get into investment banking. And then, obviously, that's when the beginning of the end started back in 1999. Now, the other thing that the Glass-Steagall Act did was that it kind of created deregulation in the financial services industry. So deregulation was really bad because, as I just said, you could get into each other's business, whether you had the knowledge or the background or the know-how to do so. Now, you could go out and you could hire people from other companies and have them join your team, or you could open departments that now would, be earmarked just for that specific area that you wanted to work in. But at the end of the day, you did not have the longevity, or these individuals did not have the longevity and the experience to be able to cope with what was about to come at that point in time. So what did that mean? Well, it just meant that banks were allowed to engage in hedge funding trading, something that banks had never been able to do. Can you imagine? Banks were allowed to engage in hedge fund trading in 1999. Now, what did this do? Well, it caused higher demand by banks, for mortgages, but, there was only so much to go around because it's all about supply and demand. But they wanted mortgages with less requirements because the lower the requirement levels and more people would qualify, and then they would acquire these homes and these properties, and then obviously the mortgages would come into play. Another thing that this brought to the forefront for the first time in U.S. history is that interest-only loans were created, just pretty much out of thin air. So that's something very important because all of us that dealt with that back in 2008, especially in my business, all of a sudden started to see people filing bankruptcies because, they bought too much house for the money they were able to afford, so that they could afford. So that created the very beginning, the end of the financial world in 2008. Now, another thing that came to being in 2008, or starting in 1999, but it actually got to the very top in 2008, was subprime lending. And actually, subprime lending was created in order to get more Americans to qualify for loans and mortgages. No income verification features, no down payment, or even they would do a fictitious no down payment. They would call it a 90-10-10. So you could get a first mortgage for 90%. You can get a second mortgage for 10% and another and a third mortgage for 10%. So it was a 90-10-10 loan, but you had no skin in the game. Because you had none of your money invested. So it didn't matter to you whether you lost the home or not, because if you had to put down 20 or 30%, like it used to be customary in order to buy a property, and something went wrong with you and your family, you were going to try to fight the very, very best to make those mortgage payments and keep your home and keep it in the family, because you didn't want to lose that 20 or 30% that you had given as a down payment. So all of a sudden, you were playing with somebody else's money, and it's always a lot easier to be able to do that. Now, banks at the same time, because of all the stuff that was going on, banks started to use derivatives. Now, you may say, well, Bert, what is a derivative? Is nothing more, nothing less than a financial contract that derives its value from an underlying asset. So a derivative is a financial contract that derives its value from an underlying asset. So this was the first time. Now, derivatives had been used, for many, many years, but the banking industry was fairly new. It was a baby when it came to the understanding of derivatives, and that's created another major problem. Now, what can you do with derivatives? Well, you can use them for anything. You can use the underlying asset. Could be oil, could be gas, could be gold, stocks, bonds, interest rates. And actually, the contract seller does not have to own the asset at all. And the reason why I'm telling you this and giving you this history lesson is that it's all happening all over again. And there's a very high probability it's going to be another major market crash in the near future. And if you're not prepared, especially as you get closer and closer to retirement, then shame on you. Because don't tell me, no one has ever told me that, because I'm telling you right now, and I've been telling you now in the past 134 weeks, almost 3 years that we've been doing this. So, it's something that you need to keep an eye on, because it is happening all around you. You just don't know it. Now, another thing that started back then, and this is one of the major problems, and it's actually what created the major crash, is something that is called collateralized debt obligations, better known as CDOs. And primarily, they were the main culprit for the 2008 market crash. Pretty much what a CDO is they pretty much buy debt and they bundle it together and sell it as a security. So, for instance, you can contact a banking institution, and they may have 5,000 outstanding mortgages, and then this institution comes in and buys the mortgages and puts them together, bundles them together, and creates a security, and sells it as a AAA or double B or a subprime investment vehicle. And obviously the more they sell it, the more money they're going to make. But all they're doing is they're bundling existing debt, and you can do that with credit cards as well. And then obviously you can start to sell that, and that's what created the crash in 2008, because there was so much paper going around that there was not enough money to cover. So that's important. Now, the other thing is that when they bundle the debt as a security, then they get to sell it off in the private, or they get to sell it off in the open market. And that would be, like I said, credit card debt, mortgages, etc. And there are two types of them. There's one that's called an asset-backed commercial paper, better known as ABCP, and mortgage-backed securities. You probably have heard of this one because this was a big issue in 2008. Better known as MBSs, mortgage-backed securities. So the most common of these derivatives is called a swap. And the most infamous of them is known as a credit default swap, which is a CDSs. And this, along with the MBSs, was actually what brought the global economy, almost to a complete collapse in 2008. To the point that when MBSs collapsed, there wasn't enough liquidity or capital to be able to pay off the CDSs, and the rest is history. Now, how many companies went under in 2008? I can remember Bear Stearns. I mean, there are many others. Countrywide Mortgages. It was. I was living in California at that point in time, and Countrywide was the largest mortgage institution in the United States, and overnight they went under. AIG, American International Group, needed to be bailed out by the U.S. government, because otherwise they were going to go bankrupt, because they had insured all of the CDSs, the credit default swaps, that were being sold throughout the world. And that was a major problem at that time. Now you may say, well, Bert, okay, this is fine and dandy, and I appreciate the little history lesson and the Gordon Gekko stories and so forth, but, why are you telling me this? Well, I'm telling you this because, once again, information without education always leads to failure. So, according to Gordon Gekko, which is a fictitious person, as I've started to tell you at the very beginning of the podcast, the ninja generation was created. So the ninja generation was created in 2008, and you may say, well, Bert, what is a ninja? We all know what a ninja is, but what is a ninja generation? Well, right after 2008, that entire generation that was just getting out of the colleges and universities and trying to get a job, they found themselves being part of the ninja generation. No income, no job, and no assets. And as a matter of fact, we're in 2020 now, in the middle, actually the day of an election, the 2020 presidential election. And we still have millions and millions of Americans, not only that have lost their jobs because of the pandemic, so I'm going to set those aside, but they've never had a job. They're still living at home with mom and dad, kids in their late 20s, early 30s. I mean, I left my house when I graduated at the age of 17 and went in the Marine Corps. So, and most of the friends that I grew up with, by the time they were 18 years old, they were gone. Out of high school, they were gone and out of the house. Well, now you have that generation of, 25, 30, 35, 40-year-olds that are still living at home with mom and dad. And that was created in 2008. And it has lingered through more than a decade. And more than likely, it's going to be around for the next decade as well. And that's something that's really bad. So the ninja generation is no income, no job, and no assets. Now, are we in a similar situation in 2020? Well, I think I just walked you through it. Now, how far will this pandemic go? What will happen to the economy? What are the safe assets that all of us should be controlling at this point in time? Those are the type of questions that I'm going to try to answer for you in the next few minutes as we approach at the end of the this podcast. But it's important to note that we are finding ourselves in a similar situation because all the stuff that I talked to you about, the CDOs, the MBSs, the derivatives, the subprime lending, all of those things are starting to happen all over again. Take a look at the real estate market. It's going through the roof. Take a look at the stock market. Now, during the election cycle, there's been volatility, and then obviously because of the pandemic, there's been volatility. But we had the longest bull market in American history. And bull markets usually last around 5 years. And this latest bull market, depending when you start counting when you start the clock, it was probably 10 to 12 years long. So that was a very, very long time for a bull market in the U.S. So I feel very strongly that we are now in a similar situation in 2020. And then obviously, who knows who's going to win the election? And depending on who wins the election, the rules of engagement are going to change totally. If Biden wins, our tax is going to go through the roof. Because although they say he says that he's not going to raise taxes to anyone that makes over $400,000, well, who comprises of people that make over $400,000? Well, you have small business owners that work 70 to 80 hours a week, that hire employees, that have to buy inventory, and they have to maintain their business, and they have all of their capital invested in their business. Who else makes over $400,000 a year? Well, professionals, lawyers, doctors, engineers, architects, researchers, people that have spent a lifetime going through college, spending hundreds of thousands of dollars in their education, and they're the ones that are going to be paying the price. And by the way, even if you raise taxes for corporations, they're not going to pay the taxes. They're going to pass the tax on to each and every one of us. And where the consumers are going to be the ones that are going to be responsible for paying the tax, and most important, the tax liability. So you got to be careful what you wish for, because you might just get it. Now, if Trump gets to win re-election for another 4 years, I think we're going to be okay from a taxable standpoint, but there may be other issues that he's going to have to deal with. And the debt in this country is incredibly high. And somebody's going to have to pay the piper. So, what's going to happen to the Tax Cuts and Jobs Act? Because it's going to sunset December 31st of 2025. So taxes are going to have to go up. By the way, if Biden wins and he does away with the TCJA, which is something that he has promised to do, that will immediately raise taxes to the vast majority of Americans. And if he starts to regulate the oil industry, and for the first time in history, the U.S. is self-supporting when it comes to oil. We don't need to buy oil from anyone in the world. As a matter of fact, we have more than anyone else. Then what's going to happen? The cost of gas prices is going to go through the roof. So that's an additional tax. Because remember, inflation is a tax, and inflation is not tax deductible. So what are some of the assets that all of us, all of you, should have in your own retirement portfolio. Now, each and every one of you is a different world, so the percentages and the type of assets, obviously that has to change, and you have to be able to do your due diligence. But I would argue that you need to have rental income from real estate. So you have to, most Americans work for their money. Very few Americans have their money work for them. And I think it was Warren Buffett that said that if your money's not working for you, you'll have to work until the day you die. So how do you get your money to work for you? Well, you have to invest in assets. Rental income is a critical asset that all of us should be able to own. Now, I have a number of clients that I do accounting for, and I do their retirement distribution planning as well. And they own duplexes. They own triplexes. They own small apartment buildings. Now, the size of apartment building could be, 15, 14 units to 20 units to 30 units. I have clients that own thousands of units throughout the United States. But at the end of the day, rental income is key, because every single month there's going to be a paycheck coming in. Now you have to manage the expenses to make certain that you have some profitability. But at the end of the day, you can be asleep, and that property is earning income on your behalf. Another thing that it would be important for you to have in your portfolio are guaranteed annuities that provide guaranteed paychecks for life. See, if you have your fixed expenses guaranteed, and you can wake up every single day not having to worry where the next check is going to come from, then you're going to have a lot more leverage. You're going to have a lot more flexibility. You're going to have a lot more opportunities for other investments that may be suitable for you and your family and your business, because of the fact that you have the leverage of a guaranteed paycheck for life. And only annuities can do that. Now, you can have immediate annuities, you can have deferred annuities, you can have, inside the deferred annuities, you can have fixed index annuities and so forth. And that would be, and I've already done podcasts on those different types of products. But having guaranteed annuities that provide guaranteed paychecks in your retirement portfolio is critical for you and your family. Life insurance is extremely important for you to own, and you can use it as asset-based or income-based, depending on how you design the contract. And the more you own of it, the better it is. And then along with all these things, another thing that you need to be able to do is you need to be able to provide tax-free income, not only for yourself, but also for your family. So when you take a look at the national debt, you take a look at the national deficit, take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt. We all know that taxes are going to have to be a hell of a lot higher in the future than they are today. So if you don't have the ability to hedge your tax liability, then you're pretty much dead in the water. So having tax-free income is critical. And if you can have a guaranteed paycheck come in to you for the rest of your life, and that paycheck is created via tax-free income, then that's a win-win for you, for your business, and for your family as well. And then last but not least, you have to be insured protected. You have to be able to protect yourself and your family from the fatal four of retirement. And what are the fatal four? And again, I've done podcasts on the fatal four as well. The fatal four, the risk of dying too soon, the risk of living too long, the risk of living with a disability, and last but not least, the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, lawsuits, etc. So at the end of the day, there are a lot of moving parts, and there are a lot of stuff that's happening throughout the world. You never know what's going to happen in the future. Also, tomorrow is promised to no one. And always remember that when it comes to your finances, sometimes you're the windshield and sometimes you're the bug. The chances are that if you're not paying attention to your finances, if you're not having these discussions that I talk about on my podcast every single week with your financial advisors, then you need to find a new financial advisor, because he or she is not doing their due diligence for you or your family. Now, for those of you that may want to reach out to me and talk a little bit about this, and or anything that may be keeping you awake at night, please feel free to give me a call. You can call me at area code 786-766-1042. You can also reach out to me and send me an email at Bert, B-E-R-T, at bertsalazar.com. And always remember that my goal for you, for your family, and for your business is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thank you for your time. Take care of yourselves. Let's see who wins the 2020 presidential election. But also remember that no matter who wins tonight, more than likely tomorrow morning you're going to get up and you're going to do the same things that you were doing today or yesterday. So I'll talk to you soon. Take care. Bye-bye.